Well, the market certainly seemed not to mind as we got US wholesale inflation on the weaker side. Will they feel the same with the consumer report when it comes out in just under 24 hours? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And that's exactly what we are going to focus on today. We'll take a look at what it was about this PPI report that the markets thought was so wonderful, and why they took that as a cue to rally up a storm. And then think about whether the CPI report was something that was foreshadowed by this reaction, or whether it turns out that it was a bit of a head fake today with this PPI, and in fact, we are going to get something else entirely. So that's really the question that's on our minds here. And of course, we'll do a little stage setting as we usually do to review what happened today and catch you up on what the markets did, and then look at what comes next. Here is the immediate reaction, and this might not be exactly where things closed. I was updating this shortly before the close, about an hour before, but it's very, very close, and you can certainly get the overall flavor of what's happened. Stocks clearly higher here. NASDAQ up 2.2% almost. S&P 500 up nearly 1.5%. Bond yields sharply lower across the curve. 10-year down 1.5%. 2-year down almost 2%. Crude oil still marching to the beat of its own drum. Some slightly cooling headlines out of the Middle East suggesting Iran might withhold retaliating against Israel for its move, which of course it still has not admitted and probably won't. But certainly Iran has decided, and the general consensus has been, that the move to assassinate Ismail Haniyeh, the head of Hamas's political wing in Tehran, was an Israeli operation, and Iran, of course, has vowed to retaliate since it happened on their soil. They're signaling that maybe they won't if Israel-Hamas ceasefire talks get back on track. So a little bit of wind taken out of crude oil here. But interestingly, gold flat, perhaps reflecting the dichotomy of lower yields and lower geopolitical risk. Dollar, though, weaker. Euro, the benchmark here, up 0.6%. The yen a little bit stronger around the idea that yields are lower, and whatever happened today with this PPI report was something that introduced still greater certainty in the arrival of Fed rate cuts in September. In fact, that's what all of this looks like. Risk on, yields lower. All of this smells like the markets looked at a soft PPI report and said, oh, goody, rate cuts. So what did that data actually show us? Well, we look at the headline here. The PPI number year on year, 2.2%. That's much lower than the revised 2.7% from the prior month, and a little bit softer than the expected 2.3%. So we have our downside surprise here. The core number, this is what excludes energy and food, that's 2.4%, lower than the 2.7% expected and down from 3% in the prior month. But then we get to a real interesting bit here, and that's this PPI excluding food, energy, and trade. Now, this is where things get curious, because on this measure, PPI actually increased 3.2 to 3.3. What trade is here is a measure of the margins that are seen by wholesalers and retailers. So this is not international trade. This is not import export. This is the price of doing business, essentially, the margin that is extracted at the wholesale level before you get to the retail level. Right? Needless to say, when you go buy something at a store, the price you pay is going to be a little bit higher at the retail level than what the store had at the wholesale level, and that's how the store exists. That's how it stays in business. That spread. The trade measure here is tracking that spread. And when you take that out of consideration, the cost structure is actually a little bit higher, which is an interesting takeaway. And if we look at what the BLS report itself is telling us here, notice what occurs. Goods are actually a source of inflation. And you can see that there was an increase of 0.6% in July. BLS is telling you nearly 60% of that increase was energy, which is how, when you take energy away and you take food away, you end up with a bigger decline than you did at the headline. Look at the month-on-month numbers here. Month-on-month, headline is up 0.1%, but take away energy and food, and it's zero. So energy, very clearly listening to the BLS here, is the lion's share of the rise. But take away the trade part, and actually the increase is 0.3%. So what's going on there? Well, if you look at services, services are actually disinflationary here. Prices for final demand services fell 0.2%. Notice this part here, though. The July decline can be traced to the index for final demand trade services, which is an index that that measures changes in margins. Now, what does this mean? Essentially, the goods side got more expensive, so firms faced higher input costs, but their margins got squeezed, which means they couldn't pass those on to consumers. Now, why in the world wouldn't they do that? Well, perhaps they felt like if they were to pass those on to consumers, then consumers wouldn't buy stuff. That essentially consumer demand is too weak to absorb a pass-through of these input costs, and that businesses decided to eat that extra, and instead their margins narrowed. This, of course, is a very interesting set of stage setting ahead of what is the consumer-focused CPI report. If, in fact, this is the read-through on this data, then it is weak consumer demand that is an issue. And, of course, that's a big concern, considering household consumption is anywhere between 70 and 80% of U.S. GDP growth. Now, the market looked at this and said, oh, good, rate cuts, as we just saw. Clearly, the response was higher stocks, lower yields. It is, of course, understandable that for wholesalers to get a lower overall structure for their pricing universe is not a bad thing in terms of their ability to weather some sort of economic downturn, which is obviously the risk that the markets have been toying with since the beginning of July. The actual likelihood of a move in September from the Fed has not materially changed against this backdrop. We can see it's still about a 50-50 shot on a 25 basis point or a 50 basis point cut. We do know that some amount of cut is now baked in with 100% likelihood. So you can see here the current target rate is out to 550 basis points. There's a 45.5% chance that we get to 525 as the upper end. So that's a 25 basis point cut. And there's a 54.5% chance that we get to a 500 basis point upper limit, which is to say that we will end up with a 50 basis point cut. So some amount of cut is essentially there. The question is, what are we going to get? The reaction in the wake of PPI would have you thinking, well, we're going to get maybe more, and that's what the market is responding to. If you look at the overall tally, though, what you'll notice is that since the beginning of July, something quite different has been going on than what was there before. Notice the rally from April here, where stocks launched their most recent foray higher. It happens as you get more rate cuts baked in for next year. The Fed is fighting the idea that they're going to have to cut more this year. So you can see the outlook for this year relatively steady. Meanwhile, the market is going, you're already late. You're going to have to do some degree of catch up next year. So the total tally of rate cuts in the gray is 2024, in the yellow is 2025, and the orange line here is the sum. So you go from a sum through end of next year of 76 basis points to double that. But then, as the Fed at the beginning of July signals, oh yeah, we're cutting, but now it's more immediate. Now we're ready to signal that it's coming not at some point in the future, but at the next meeting, which is September, after July's meeting, where they made this update to the language official. Instead, we're cutting because the risks to inflation and growth have become balanced. And that's the message that we got from Jay Powell in early July. And that's, of course, where this turn occurs. Notice the markets start to develop a very different relationship with the Fed policy outlook. Now they move down together. Because now, after the Fed gives us this tone shift right here, and then, of course, makes it official here with the actual policy announcement, after which things get spicier still, right here, these things start to move down in tandem. So the market is telling you, no longer am I cheered by the prospect of rate cuts because these are the wrong rate cuts. Rate cuts for maintenance reasons, to keep real interest rates in check as inflation expectations fall, but with steady, okay growth, that's a good thing. Rate cuts because the risks to unemployment have balanced with the risks to inflation. That's a risk to growth. Those are rate cuts aimed to stimulate a weak economy, not to manage real rates for an okay economy. And so it's a very different kind of narrative. Notice that the recent rebound in stocks has come with not a dovish, but a slightly less dovish adjustment in policy expectations. And so the markets here are seemingly saying, today's PPI data notwithstanding, and the reaction there too, of course, we're concerned about the business cycle. We're concerned that the Fed has missed the boat, that they're going to rush to cut now, and that this will be too little too late because the economy is already going in a recessionary direction. So that there is a sign seemingly of underlying consumer weakness in this PPI data, and granted it's buried, but if that's what this is, then the CPI report will show it in sharp relief. And that may well be negative for stocks, much the same as today's release was positive. Here are the expectations. 3.2% on the core, 2.9% on the headline. And depending on which aggregator you look at, it's either 2.9 or 3. It looks like the rounding here is very, very close. And so whether you look at the aggregate of forecasts done by Bloomberg or Reuters or Haver or some other outfit, you get slightly different numbers. The expectation from the Cleveland Fed's nowcast skew a little bit higher. They have 3.3 for core, 3.01 for headline. Notice, though, that the Cleveland Fed's model has been a little bit warmer than realized results since April. So here's the headline here. You can see the yellow is the Cleveland Fed's forecast model, and this is the realized CPI. Down here is the core. In the green is the Cleveland Fed's model. In the red is realized numbers. And you can see here, since April, which is right there, the Cleveland Fed has been running hotter than realized results. Because we are so close, at least on the headline, the Cleveland Fed's at 3. Consensus forecasts are 2.9, leaning 3. If this undershoots again, there's meaningful downside surprise risk. You could come in at 2.9 or even 2.8. For the core, the Cleveland Fed's at 3.3. The market is at 3.2 for the forecast. You could miss by a wider margin here if the trend continues. In fact, the trend toward missing has been well developed at this point in overall U.S. economic data. You can see that since mid-April here, we've moved not just from beating expectations by a narrower margin, which was the story here from July of 2023 through the beginning of this year. Now we've moved to actually disappointing or tending toward disappointment relative to forecasts, as this Citigroup Surprise Index for U.S. economic data has pushed below 0. So if we were to see that the Cleveland Fed is once again overstating realized results when they come out, that would be consistent with what's been going on with U.S. economic data more generally. And of course, the PPI number is included there. It also missed. So the question really is, do we get the kind of reaction we got today, or do we instead say, well, it's one thing for businesses to see lower costs, that helps them in an economic downturn. It's a whole other thing to see consumer demand weaken and for that to give us weaker upward pressure on prices, because that's a much bigger concern for the business cycle. And so in the context of what this means for the S&P 500, this could not have come at a more auspicious time. Notice the trend going back to the beginning of November, late October of last year, that has given way. So the up move here is already broken. And where we are now, having retested higher from last Monday's very aggressive volatility, is right back to the point where the break occurred with disappointing U.S. jobs data on August 2nd. This is another one of those things where bad data was bad. Something more dovish in terms of its inspiration for Fed policy odds was negative, not positive for stocks. In fact, today's reaction to PPI is something of an aberration when we compare to what's been going on since the beginning of June. And so since you've arrived now at this key spot, 54.32 to about 54.80, that's the underside of this range, and the gap fill from where the breakdown occurred on August 2nd with that jobs report. If this holds right here, because the markets get a weak CPI number and take it as bad news, If this ends up a place where you round the top and you come down, then what you have is the next leg in a developing down move, as defined by lower highs and lower lows. If, on the other hand, you crack higher from here and put the 56 figure back in focus for the S&P, well, then the story has changed again. And now we apparently have decided that at least that September cut is locked in. There's not much more cyclical concern to think about as long as that 50 basis points occurs. And perhaps then the market has figured that the Fed will, with a jumbo-sized cut, have caught up. Whatever the markets thought here then, where they were baking out more catch-up for next year, because the Fed was saying, no, not enough disinflation yet to cut any more than once this year. That was their update in June. If the Fed then is all but certainly going to cut 50 basis points and the market rallies, that is, this skew goes, let's say, to 60-40 or 70-30, and the market says, well, this is good things happening, not bad things, and there's not more cyclical damage to do here, well, then this down move may have ended for now. But if the market instead says, okay, they really do have to do 50, and we don't know how much more they have to do thereafter because they've already missed the boat, and maybe they have to scramble still more, then you have a very different story on your hands. And then you might well have this hold as resistance and another big leg down to follow. And that is macro money for today. As ever, we are here every Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might augur for next steps. I'm on with Victor Jones for the Price of Truth tomorrow, on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.